This video illustrates how to determine a discount rate for valuation in the closely related topic of capital structure assumptions. One thing you have to be aware of is that despite all of the seemingly precise computations, you need to embrace the fact that your estimated discount rate is wrong. Unfortunately, there isn't a good way to estimate discount rates. We'll take some steps to dealing with that problem when we cover sensitivity analysis. We'll focus on discount rates based on the weighted average cost of capital, or WACC. As the name implies, we compute WACC as the weighted average of the returns to the components of enterprise value. What we would like is a rate that reflects the risks of operations, since we're discounting cash flows from operations, but we can't observe that, so we try to infer the appropriate discount rate from returns we observe on traded securities. The components of value should be market values whenever possible. Conceptually, WACC reflects both the risk of the cash flows and the tax benefits from debt. The formula assumes that the company will maintain a stable debt structure in terms of market values. The computation estimates the unlevered return, which reflects the risks of operations, with adjustments that incorporate the tax effects of debt and cash holdings. We typically use the CAPM to estimate the equity return. Under the CAPM, we view the required return on equity as being related to how much the returns correlate with the market, as reflected by the beta. We can also view the equity return as representing the unlevered return on the overall enterprise, with adjustments for the effects of leverage. You may notice that this formula has the same structure as the DuPont decomposition we used for return on equity. Now let's look at how to pull the numbers. For the equity return, we need an estimate of the risk-free rate, the CAPM beta, and the market risk premium. I usually go with the 10-year Treasury for a risk-free rate, since it's a relatively long horizon consistent with when we're getting the returns on equity. You can find estimates of the CAPM beta in a variety of places, such as Yahoo Finance. Conventional estimates for the market risk premium are something like 5 to 6%. For the debt return, we can estimate the return using the interest expense and debt balances, which gives a 5.2% debt return for the Sprouts example. We can also look at the financial statement notes for rates on the outstanding debt, which gives 3.5% for the Sprouts example. This example shows data from Kroger's financial statements, from which you could compute a weighted average rate on existing debt, giving a rate of 4.4% for Kroger. Alternatively, Capital IQ states that Kroger has a BBB credit rating, and BBB bonds currently yield about 3.4%, so that would be an alternative estimate. Another approach to estimating the rates is to use comparables, which I'll illustrate on this spreadsheet download from Capital IQ. When using this approach, keep in mind that you want to control for operational risk, so focus on companies with similar operations just as you would for comparing performance. In fact, I'll use the same companies for estimating discount rates that I used for benchmarking Sprouts' performance. On the bottom of the sheet, I have summary statistics, where we would probably use the average or the median for our rate estimates, but we can also refer to the other percentiles for a sense of how much of a range of rates we might consider for the initial valuation, or for sensitivity analysis. I compute the enterprise value from the market cap as given by Capital IQ and the most recent book values of cash and debt. Ideally, we use market values for debt as reported in the financial statement notes, but that usually does not differ much from the book value. I computed the after-tax rates on debt and cash just as we did when computing the DuPont composition of return on equity, dividing after-tax interest by the average balances. You can also look at the Capital IQ data on the borrowing costs. To compute the equity return, I used the CAPM based on a 2-year beta reported in Capital IQ. This estimate is based on weekly returns, so it's estimated with relatively recent data and with a large sample. There are many ways to compute betas, such as with daily returns over a 1-year horizon or monthly returns over a 3 to 5-year horizon. Capital IQ also directly reports its own estimate of the CAPM return and the company's WACC. Note that the equity returns of about 5% for a comparable sample are about half of the 10% I used for the equity return previously in our Sprouts example. The average and median WACC computed by Capital IQ are about 3%, and the average and median WACC that I computed are about 5%. Much of this difference is in differences in how I computed the equity rate of return versus how Capital IQ did. Now let's apply this rate to our valuation. The example previously had a WACC of about 9%, which is much higher than the 5% estimate using comparables. Using the lower discount rate will yield a higher value. In this case, the estimated enterprise value increases from about $4.7 billion to about $42 billion, a massive increase. This is way out of line with Sprout's current valuation, and we'll see in the next video that much of this has to do with our terminal value assumptions. This completes the video on discount rates under the WACC assumptions. The notes posted on CCLE discuss alternative capital structure assumptions, and the circumstances under which they might yield a materially different estimated value than valuation under the WACC assumptions.